Hi and welcome. My name is Casey Boland. I'm a wealth advisor and partner here with HCM Wealth Advisors. And I'm joined today by Doug Johnson, who's our senior investment strategist and partner with HCM Wealth Advisors. Welcome to our webinar. Now, if you'd like to ask a question, please go to the bottom of your screen and click on Q&A. There you'll have an opportunity to submit your question and we'll do our best to answer at the end of our webinar. So Doug, it's been a month. If we think back to September, the concerns at the time were we had signs that economic growth may be slowing. We just wrapped up a fantastic quarter of strong earnings growth, but earnings, what's going to be the pace in the future? We had this torrid pace. Is it going to slow down? Inflation concerns, those continue to linger, and the ever ongoing headlines about the debt ceiling and the fear that the US could default on its debt. And lastly, you had the stock market. It was flirting with a 5% drop off its peak, which it did hit soon thereafter. So now we fast forward a month later to today. It's like the same picture. We've got signs that economic growth, it may be slowing. You've got questions still about earnings growth. Is it going to continue at the same pace? Lingering inflation, the debt ceiling now it's been kicked on to December to be dealt with then. So we look at these issues. Now, two changes worth mentioning. One is what's happened to the stock market since a month ago to now. And then two, inflation. It's still lingering concern. More people are debating that this premise that inflation is anything but transitory. The jury's still out on inflation, but with these pressures, they continue to build. I think it's giving the Federal Reserve some fits and thinking about how to predict the future here. So we're going to talk about these different issues. We're going to talk about inflation, how the stock market may be setting up, and the bond market's interpretation of the outlook for economic growth and inflation. But before we get too deep on these subjects, let's shine a light on Social Security. So guess what? Your checks, they're going up by 5.9% next year. That's the highest increase since 2008. And the last time we had that type of increase, it was 5.9% or more. If you think about back in 1982, it's 1982. Does that ring a bell? That was the tail end of the high inflation period, the 1970s and the early 1980s. So before we move on, let's pause. Let's look at this chart a little bit. So since 2008, there's only been 1 year here when Social Security increased by more than 3%. In 09 and 10, that's not a typo on the screen. There was no increase during those 2 years. And what that's meant for our clients' living expenses and withdrawals during the last 13 years, is they typically increase their withdrawals occasionally, as we were dealing with a disinflationary period where inflation slowed, then we flirted with the risk of deflation at times during a very slow economic grind environment. So in 2020, many of our clients, just like everybody else in the world, you cut back on the expenses because of COVID. You just couldn't do much. So spending was down. But given the increase we've got in inflation now and the desire to do more, please don't hesitate to reach out to your advisor if you'd like to discuss changing your withdrawals, whether that's now or in 2022. We're glad to help. So Doug, all right, let's get back to business. Okay. What's happened with the market in the last month since the debt ceiling standoff?
So not a whole lot. I mean, if you go back to the last presentation that we did, which was right around this time in September, you had the debt ceiling in the news. You had the beginnings of Fed tapering conversation. You had inflation worries. You had all these things that, for the most part, still exist today. But you were starting to enter that time frame where the market was showing a little bit of volatility, and it had been close to 200, a little more than 200 days since we had a 5% correction, which is an extremely long time in any type of volatility regime. But I think people were starting to get a little nervous, and they were saying, okay, here's the perfect setup for the market to truly have any kind of corrective action or even a significant sell-off. Well, sure enough, we got our 5% correction, and it came and went pretty much in the blink of an eye. If you look at the returns in front of you here, this goes back just 1 month, and we have all the major asset classes here covered. So let me pull out my laser pointer here real quick. There we go. So in the top here, we have green representing the value factor ETF or value as a whole. Right below that, we have the Russell 2000, which represents small caps. Then we have orange, which is just the broad market. You have international here, and then you have growth here at the bottom. But the main takeaway here is for all of the things that everyone was worried about, and granted, I think there were a lot of concerns that were worthy of people's attention, and I still think those things exist. Here we are with a 1 month return in the market being pretty positive across the board. So I know a lot of people are kind of looking at this market and shaking their head and saying this can't keep going on like this. There's got to be something down the road that's going to happen. There might be, but for the time being, the market remains strong, and the returns are certainly backing that up for the time being. Now, if you've been a part of these webcasts over the past year, you've heard us talk a lot about the idea of reflation. And just to recap what that really means is coming out of the summer of last year and into the election cycle, you started to get some inflationary pressures. You started to get some belief that economic growth was going to come back. And the big kind of accelerator to that was the rollout of the COVID vaccines. So if you remember the day that the announcement was made that there was going to be a viable vaccine for people was right around the time of the election. And with that came the possibility in a lot of people's minds that we were going to be able to go back to normal, that the economy was going to be able to open back up, and we were going to be able to put COVID behind us. So based off of that, we saw the reflation trade really start to pick up. Now, as we look at this chart, this goes all the way back to February of 2020. So right at the very beginning of COVID breaking out. So what you'll see is this is just a ratio chart showing a reflation basket, and the reflation basket and themes are represented by things like commodities, real estate, energy, banks, hotels, things that are very cyclical, very economically sensitive. And then the COVID winner stocks or sectors are going to be things like at-home entertainment. So something like a Netflix, your online retail, the digital economy, COVID-friendly travel, social media, things that are basically ensuring that you're not leaving your house and everybody's going to have to do everything in the confines of where they live. So when COVID started in earnest, the performance of those COVID winner stocks really outperformed the reflation basket. As we can see, as this line moves down, this just means the reflation basket is not performing well versus those COVID themes. So that takes place all the way down in a significant number here, all the way down to a trough right around the middle of summer in 2020. Then you started to see a little bit of pushback with the reflation into August, big jump, another drop, and then now we're slowly moving our way up. We get right around that November date that we mentioned before. We're kind of halfway through this as I think there was some expectation that this was going to take place. And then we get a reacceleration all the way through to right around, I'd say, the end of the first quarter of this year. Now, what happened then, you had the Delta variant popping up. You had concerns that the best of the growth rates, both economically and from an earnings perspective, were behind us. And we may start to fall into the same pattern that we saw in the early parts of 2020, where rates were going to come back down, deflation pressures were going to come back up. And what you can see is these COVID winners that were successful in 2020 started to become successful again. And we come to a point here a few months back, and we start to see the Delta variant waning a little bit. We've showed a lot of COVID charts over the past few months, and we didn't include one in this particular presentation. But the numbers nationwide continue to come down. Inflation pressures continue to pick up. And what you're seeing is the possibility of what we would call reflation 2.0. And we've seen that basket of cyclical stocks begin to move its way back up. And I think this is an important theme in the market because it's been a while since we've seen this kind of zigzag of leaders taking place. For the past, I'd say 6 or 7 years, growth has really dominated the performance landscape while, value has lagged a little bit, but now we're actually seeing different leaderships taking place in different regimes. And I think it also very much depends on the function of the yield curve. And we're going to get into that a little bit later in the presentation. So now we've talked about earnings, and those are going to be the ultimate driver, I think, of where stock prices can go. If you look here, we see a huge trough in 2020 as COVID hit, global earnings growth down 30%, and we see a massive rebound up here where earnings growth is up 46%, a huge number. But all of a sudden now you're starting to see a little bit of a drop off here in terms of growth rates. Now there's both positive and negatives here. The negatives are that you're starting to have the questions asked of have we reached peak growth in terms of earnings growth, and decelerating earnings growth is not necessarily a bad thing, but it's also not necessarily a good thing. And I think we've got some pretty healthy valuations right now, certainly valuations that are above the historical averages that we've seen. And while that's not going to necessarily cause a market crash or a significant correction in the near future, what it has been a pretty good predictor of is showing us that when you start at a point of elevated valuations and you go out 10 years forward, the evidence shows that the average rate of return for equities is going to be below average. And it's kind of hard to comprehend that right now because we're in a really good market, returns are very good. But as we look forward, starting to think about how we're going to combat an environment where you possibly have below average equity returns, but also below average fixed income returns, that's going to be a challenge for a lot of people. So certainly want to keep an eye on that. At the same time, it's really hard to have a significant drop in the market when you have absolute earnings growth at the levels they are. So even coming off of 46, I mean, if you go back and reference these numbers, here's 23. So this is right around still 30 to 35% year over year earnings growth. That is going to be pretty supportive to equities going forward if we can maintain a level in the high double digits that we're seeing right now.
Hey, Doug, I know we keep hearing, I'm going to be talking about it as well, but you keep hearing supply chain, supply chain, supply chain. Are there any signs that supply chains are pressuring profit margins?
Yes, very much so. I mean, look no further than Procter and Gamble, the company that everyone in Cincinnati is associated with. They had their earnings call this week and mentioned that their input costs are, moving up significantly. And while they're planning on increasing prices across their brands, it's not going to be an amount that's going to match what they've seen in input costs. So, and it's not only, it's not unique to them. Anybody that has to rely on the supply chain to source any kind of input is seeing increases across the board. So when your input costs are higher than what you can sell your product for, that's definitely going to squeeze margins a little bit and cause some issues there. So yes, I think it's having a significant impact across the board. So we talked about valuations a little bit, and they have certainly been a concern for a lot of people over the past few months. But what this chart shows is, maybe we're seeing a little bit of good news here. So at the peak where we had this year, you had trailing 12-month PE ratios north of 30, which is almost astronomical levels, and certainly not a good starting point for future returns. But since then, we've had stock prices continue to move, we'll say sideways or higher. But you've had these PEs drop significantly, basically because the earnings side of this is getting better. So if you think about price maybe staying the same, but earnings growing significantly, that number is going to come down quite a bit, which it has, right around 26 right now. still well above the 10-year average here in blue and above the 5-year average here in green, but we're certainly moving in the right direction in terms of valuations. And I know that's been a big concern of a lot of people saying, hey, we can't sustain this market at valuations this extreme, but the situation is improving there as earnings have rebounded pretty well. Now, as we look at the global landscape for valuations, we see a theme that's been in existence for a while now. So if you take the dark blue line here representing the S&P 500 or US returns, and then the lighter blue line here representing, we'll call it developed international, and then you have the orange line representing emerging markets, what we see is the valuations outside of the US continue to be more attractive than the US. And it's, you go back to 2011, it's kind of ebbed and flowed a little bit where the valuation differences have come closer, then they've spread out a little bit. But here is one of the biggest gaps that we've seen since this chart started back in 2007. And I think the frustrating thing for a lot of folks is that this should portend good returns for international versus US. But unfortunately, it has not played out that way over the past decade. And the setup is certainly there. And we still believe that there's a place for international equities in clients' portfolios, and partly due to this chart right here. But I think until we can see some sustained performance for international versus the US, we're not going to be as willing to maybe lean into our international exposure as much as this chart might indicate that we should be thinking about. But I know this has been a sticky subject for a lot of folks over the years. But when we think about valuations and reasons to invest in international, I think this is as good a chart as any to show that differential. And then lastly, growth concerns. So we're going to talk a lot about inflation and inflationary pressures for the rest of the presentation. But one of the things that we're seeing right now is concerns about growth. I mean, we talked about reflation and the idea that the economy is going to be able to rebound as we see a more permanent reopening. But this is the Atlanta Fed has a forecasting model called GDP Now, and it's a real-time GDP forecaster. And what you can see pretty clearly is that this was peaking back between April and May. So right at the end or the peak of the reflation basket doing really well, you started to see that this drop pretty significantly. And now the GDP forecast based on this is slowed to about 1.3% per year. So when we're going to spend a lot of time talking about things that can cause inflationary pressures, this is certainly something to pay attention to as a concern that could, be one of those deflationary pressures on the other end to, I don't want to say keep inflation in check, but certainly if you had an environment where inflation did not stay in check and these forecasts came true, you could be entering into an environment which is what they would call stagflation, and probably, jokingly, is the worst of deflations in these scenarios. So certainly something to pay attention to, and we would hope to see these GDP numbers improve, but they're certainly not going in the right direction right now. So, Casey, I know we I've spent some time talking about behavioral biases over these presentations, and you and I have done some in-person presentations around behavioral finance. But explain to me exactly what is on this slide here.
So yeah, we're going to take a little bit of a sideways turn here for a little bit. And what you're seeing is someone eating out of a massive container of ice cream. So what does that have to do with behavioral biases? Well, it's the framing effect. So this is the framing effect when, and what that is, it's when our decisions are influenced by the way information is presented. So if you remember, when ice cream container size shrunk, you went to go buy ice cream in the freezer section, and they shrunk the size of it with no price change. They thought, ice cream manufacturers thought they were going to slip that one right by you and fool you. But anybody who sat with a spoon eating out of a half-gallon container knows better. Now, so I've been told. Now, so that's an example of framing. And then if you want to be a politician, you better be an expert in the framing effect. So let's move on. We're going to talk about some other behavioral biases. So if we go to the next slide. So, hey, the McRib is back. So Doug, did you know when you look back in history at the performance of the S&P 500 when the McRib is sold, so it's usually for a 2-month period of time, the average daily return is considerably higher for the stock market. I mean, you can see it here on this chart in the daily outperformance. When you annualize that figure, that would equalize to an annualized return of an additional 19%. Now, I don't know what's in the McRib. I don't know if I really want to know what's in the McRib, but bring the McRib on. So, but again, this is another one of these behavioral biases. So this is one of these, Doug, that you have to act now, starting in November. And this is another example of, we joke around the office when we see charts like this. It's like, where's the chart police? This is a clear chart crime. We see this abuse of data and charts all the time. So this is an example of data mining. I know it's a silly one at that, but data mining is ransacking data for hidden patterns. So it's okay to use historical data for research, but this can lead people to conclude that stronger correlations exist than maybe really do, when in fact, maybe the results you're seeing are a little bit more a matter of a coincidence than anything. So why are we talking about these different behavioral finance biases? Well, it's very easy to frame and data mine economic and investment data that can be very misleading, such as inflation or that shiny object gold, which we're going to touch on later as well. All right, so let's get back on track here, and we'll move on to inflation. So we mentioned earlier that you can't go a day without some type of financial publication has inflation mentioned. So inflation comes in a few different forms. You've got cost push inflation, which is caused from a decrease in the supply of goods and services and or an increase in the cost of raw materials and labor. So think about the 1970s oil shock. That's a great example. Or demand pull inflation. That's caused from an increase in overall demand that's greater than supply. So we're seeing a lot of that right now in this current environment. So let's take a look at a few examples of this. So let's take a look at cost push. So if you look on the right-hand side here, we're looking at natural gas prices. So Doug, have you turned the thermostat on in the house yet for the heat in your home?
I have not. I've been close several times, but I have not actually turned it on yet. So hopefully this is not affecting me, but I'm sure that some people out there have given in and turned the heat on over the past few days.
That would be me fighting with my wife over the thermostat. And so winter's coming, and when you see this chart on the right-hand side, this is a great example of cost push inflation. So the U.S. Energy Administration, they're forecasting that about half of the population is going to experience a 30% increase in their energy bill as natural gas prices have shot up. Now you look on the left-hand chart, and you're going to see a lot of areas where Americans are experiencing inflation. Now, they're not all cost push. In some cases, they're demand pull, but you're going to see in cars, whether it's used, new, or rental, discretionary items. Inflation is widespread. You see it in meats. All right, let's move on to the next slide. Let's look at demand pull slide. So when you look at demand pull slide, look at the surge in consumer spending. In many cases, this is an example of demand pull inflation, is you've had an increase in overall demand that's greater than the supply. So supply chain problems, we know, have been a big contributor to this issue. And at this point in time, I'm wondering how many companies are rethinking the just-in-time inventory model, given the disruptions in the supply chain. So going to the next slide, inflation. When we put it all together, you've got demand pull, cost push inflation. You can see the huge jump in the consumer price index over the last 2 years. As the supply chain kinks get worked out in the coming quarters, the question is going to be, is inflation more sustained, or will inflation ease down to the 2 to 3% range where I think a lot of people are expecting it to be? I don't know that we know the answer yet at this point. Now, one more slide before I hand it off back to you, Doug, and it's one that doesn't seem to fit, but this one puzzles me when we take a look at a lot of the slides we've looked at so far. So we're talking about inflation, but looking at the amount of excess cash that is stockpiled since the pandemic began back in early 2020, it's close to $2.5 trillion. Now, it's made sense that people couldn't go out and spend, and consumers were concerned about the potential impact of COVID on the economy, as well as being locked up. So cash was accumulating, but it's continued to grow all along this time up into even recent months. So I don't know to what degree this is stimulus-based savings, with some people loading up on savings, and you're hearing about people quitting their jobs. Now they've got reserves with this high job quit rates. Could this be help to deal with inflation pressures, knowing that more of their dollars are going to be needed for higher costs? Maybe it's supply chain issues. No, I don't know. But when you think about inflation again, you could make the case that inflation could be a whole lot worse right now, or maybe lower than the current picture. And I'm just not sure. I mean, the supply chain component really throws a wrinkle in this. So on one hand, more spending or the cash built up could increase inflation. We saw the chart showing consumer spending's high, and the consumer price index has been surging as well. But Doug, you shared a slide earlier, that economic growth picture. It's showing economic growth potentially slowing. So to what degree are the supply chain issues contributing to slower economic growth? That may go hand in hand with the reason cash is built up, is consumers want to spend more money, but because product isn't available, they can't. So as evidenced by this excess savings slide, there's a massive amount of excess money here that it's been banked. What if consumers want to buy more, but because of the supply chain issues, what if they can't? So if product, though, let's just pose this question. If product was available and they did buy, would a healthy supply chain more than keep up with the demand, possibly keeping inflation pressures and contained, while at the same time lifting economic growth of that chart that you shared earlier? I mean, I think this is why the Federal Reserve and others, they are really struggling with the degree of how transitory inflation is, how to deal with monetary policy issues. Doug, I hate to say I'm kind of wearing myself out here on inflation. So I'm going to let you take the reins here on inflation and help connect some more dots for us.
Well, yeah, and before we go forward here, I want to go back to this chart real quick. So two things that I think are worth noting. While this line has certainly moved up, it's not anywhere off the graph, so to speak. We haven't had to reframe this graph at all to fit in. So we're basically up back to the levels that we saw in 2007. And in some charts that we were looking at in preparation for this, we've seen similar inflation levels to what we've seen since 2014. And I was joking with Casey. I said, do you remember the great inflation scare of 2014, or even the great inflation scare of 2007? Most people don't. So now, let me be crystal clear. Certainly not making a call that inflation can't get worse. But I think we're in a very unique situation here where we're seeing a little bit of the cost push and the demand pull at the same time, causing inflation to really ramp up. And you've seen different projections for when the supply chain is going to open back up. And it's hard to say. And the longer that takes place, obviously, and the more money that's built up in the system, it's naturally going to cause things to continue to drift higher, and the pressure's going to continue to be there. Another way to think about it, and we've maybe indirectly talked about this before, but some of this excess cash is finding its way into the market, and you're seeing asset price inflation in both stocks, things like real estate, happening under these same dynamics. So a lot of things that are playing into this right now. And I think, as you said, I think the Fed is caught a little bit off guard because, well, I don't know if they were caught off guard as much as they were praying behind the scenes that inflation was transitory, so they would not have to, have the taper conversation again. And we're going to see why at the end. But their acknowledgement that this is a little bit more than transitory, I think, is very telling. So, when we talk about inflation and how it relates to your portfolio, a lot of people have asked, okay, what's the best way to hedge inflation? And I've seen a lot of articles coming up about things related to equities and how equities are a great inflation hedge. And JP Morgan did an investor survey just this year, and they asked 100 advisors and investors, what is the best way to hedge inflation? Number one answer was obviously commodities, and commodities have performed really well this year. But then you have stocks. Now they say energy and materials, but I think on a whole, people think stocks in general are a good inflation hedge. Then you have things like tips, and then other. Maybe we throw gold into this as well, which we'll talk about in a second. So when we look at different inflation regimes going back to 1947, what you'll see in this color-coded area is the blue represents inflation less than zero, so almost a deflationary environment. You have green representing between 0 and 5, and this has been the dominating time frame at 505 months of this sample. Then you have between 5 and 10, which some would say that we're there right now, and it seems to be denoted on this chart at 181 months. But then we have what I'll call the massive inflation that's over 10%. We've only had that for 59 months, and a majority of that happened during the 70s, during the oil shock that we mentioned earlier. So looking at these time frames and looking at the excess real return on a monthly basis for equities, we find something that's, I think, interesting. And we look and we see that the worst real performance during this comes when inflation is the highest. So there's only a 0.1% real monthly equity return by inflation in that whole regime when we have inflation over 10%. Now, what does the real component of this mean? It basically just means it's adjusted for that inflation number. So let's use a hypothetical. We'll say equities return 15%, but inflation's running at 4% or 14%. The real return there, the nominal return of 15 minus the inflation portion of that at 14, comes out to be 1%. So when we look at this, there's a lot of different ways to look at it. It's almost kind of a Rorschach test here and how you want to see this. But some would say, okay, well, equities do act as an inflation hedge because you still had positive returns here, but the excess return is not that significant. And what I think the danger is right now is a lot of people are maybe taking this idea that inflation is a perfect, or that our equities are in a perfect hedge for inflation, and thinking we're just going to disregard fixed income in our portfolio and we're going to load up on equities because that's going to get us through if we have a high inflation regime. And I don't think that's necessarily the case, because I think the Fed is way more involved in this cycle than they have been in the past, and the dynamics have changed significantly. So, we've taken a lot of time internally to think, okay, how can we add things into the portfolios that are going to act in a good way if we see inflation, while not adding too much risk to the portfolio. So especially on the fixed income side, we've added a lot of kind of global macro or go anywhere strategies that have done really well this year and helped combat inflation. But on the equity side, things like value, things like small cap, and dare I say it, international should perform well in an environment that is inflationary. But I think this dispels the rumor a little bit that equities are the be all end all of inflation hedges for portfolios. Now that brings us to gold. Gold is one of the other kind of things that clients believe that you want to hold gold in an inflationary environment. So let's see how that's played out. So the total return we have inflation rate in orange, we have REITs, which represents real estate in gray, commodities in blue, and gold in gold. And it breaks us down by the significant inflation regimes that we've seen over the past 50 years. And we go back to the 70s, and what we see is gold was a very, very good inflation hedge, performed extremely well. So did commodities, so did real estate, but they all outperformed the inflation rate pretty well. So if we were just looking at this time frame, we'd say, okay, gold is a good hedge. But then we look at the next two and we see a very different picture. In fact, gold actually had a negative return in both of these time frames with positive inflation, where real estate was the top performer in the early 80s, followed by commodities. And then you get in the later 80s, you've got commodities outperforming real estate. But again, if we were just to take the mantra that gold is the be all end all of inflation hedges, and if gold, inflation's coming, you need to act now and get gold in your portfolio. It's not necessarily the case. What gold is very much related to are real interest rates. And the more negative real interest rates go, the better that gold does. So if we look at the history of 5-year real rates versus the price of gold going back to the early 2000s, you can see very clearly this inverse correlation. So when the real return is negative, so basically when you have your nominal treasury security, so let's say that the 10-year right now is yielding, I believe it's close to 1.65. And we'll say inflation for the purpose of the example here is running at 3.65. So that equates to a negative 2% real yield. And when real yields are way down here, you can see that the gold price is way up here. So in a period of negative real yields, gold will perform well. So think about back in the 70s, you had extremely high inflation, and it took a little bit of time before the Fed Chair Volcker came in and said, hey, we're going to raise rates to combat inflation. So you had that big negative real yield for a long time where gold performed well. In the other environments, not so much. So the point is that if inflation remains high, but treasury yields start to catch up to that real yield will start to move higher, and it could put pressure on gold. So does gold have a place in the portfolio as an inflation hedge? Yes. Does it have the exclusive inflation hedge? I would say probably not, especially depending on how the real yields are going to look. So again, when we're talking about inflation hedges, there's more than one area of the market to look at. And I think they all operate differently in different types of inflation regimes. Now, let's go ahead and look at treasury rates and see what those have looked like over the past few months. Now, what you'll see is everything is starting to move up. So you've got the market implied inflation expected rate about 2.37. You've got the 10-year moving to 1.65. You have the 10-2 treasury spread, or the yield curve at 1.25. And then you have the 2-year yield, which has really started to move up. I mean, it's been basically pinned at the floor at 15 basis points for a while. But now, as there's expectations that the Fed is going to come in and either taper and or start to raise rates at some point to combat inflation, you're starting to see that 2-year yield move up, and it's starting to affect the yield curve a little bit, and it's starting to mess with the shape of the yield curve. Now, why is that important? Well, let's look at a kind of visual example of what we've had going on here. So go back all the way to November 2020. So this is right when the election happens. This is right when the COVID vaccines come out. So there you had a 2-year yield at 16 basis points, and you had a 10-year yield at 87 basis points. So the spread between those is pretty narrow. That's what we would call a flattish yield curve. Now, as we move to April 2021, so this is kind of the peak of reflation 1.0. So again, you have the 10-year bond at 15 basis points, but you have the 10-year that's gone up almost a full percent, right? So when we connect these two time frames together, what we see is that the 10-year basically went sideways, but the 10-year yield went up. So that is what we would call a steepening of the yield curve. So the spread between the 2 and the 10-year is getting wider. And when we see a yield curve that is steepening or getting wider, that is a positive for things like value, positive for things like cyclicals, small cap, international, not necessarily a positive for things like fixed income. Now, let's look at from the peak of the reflation 1.0 to the middle of July. So 2-year yield, yeah, up a bit, probably sideways on the whole, but now you have the 10-year yield dropping almost 35 basis points. So again, 2-year yield sideways, 10-year yield down. So what we see there is a flattening of the yield curve. So as the yield curve begins to flatten again, all of the things that were out of favor for the first 4 months of the year are now all of a sudden coming back into favor. And you're getting this yo-yo effect. Lastly, from the middle of July up until now, we've seen the 2-year yield move up fairly substantially. We've also seen the 10-year start to move up. So now you're getting increase in the 2-year, but you're also getting increase in the 10-year. So you're getting a little bit of flattening of the yield curve, but you're getting both yields moving higher. Now, that brings in the idea of, are we about to see a reflation 2.0? Not necessarily sold on that yet, because one of the things that we're seeing start to take place is concern about the Fed making what we would call a policy error. So the policy error is basically a decision by the Fed to taper into an economy that is slowing. And what they would do is they would increase short end rates, which would lead to the expectation that the growth slowdown would be accelerated. Okay. And that would, in essence, cause long end rates to drop. So a good way to think about the 10-year yield is it lines up pretty well with GDP growth. So now you've got a short end moving higher and you have a long end moving lower, which is going to flatten this teeter-totter out. And as the yield curve flattens, with the potential to invert if recession becomes on the table, you're going to start to get into an environment where the things that seem obvious to invest in from an inflation standpoint might not be working, because the yield curve is doing very unusual things in the face of what's going on. So the concern here is that the Fed may act because they have to put inflation in check, but if they do it too quickly and they basically squash the economic recovery, you could see reflation 2.0 get squashed pretty quickly, and you may see COVID trade 2.0 come back into favor. So as we've talked about positioning in portfolios, and we've kind of gone back and forth between value, reflation, growth, deflation. At the beginning of the year, we very much had a higher conviction in the value trade. We've taken that back a little bit. We really are we're waiting for this scenario to play itself out to see what direction the Fed's going to go in and what way the yield curve is going to react to this, because I think it's going to play a huge role in who is going to be the market leader going forward and how portfolios need to be positioned to kind of get as much of those scenarios in as they possibly can. And then lastly, why is it so important for the Fed to get this right? Well, here is a chart that I think some people may have seen before, but it's an uncanny chart. This is the amount of the Fed's balance sheet in purple against the return level or the total level of the S&P 500. As you can see, those lines match up pretty closely. And as the Fed has been adding to their balance sheet or doing quantitative easing, the market has followed along with it. The two instances where you see this starting to fall off here, you got some volatility around here until they said, all right, we're done with this. Obviously COVID here, but you can see the massive spike in response to COVID, and the market has followed along since then pretty substantially. So why is the Fed tapering and the yield curve so important to equities? This relationship right here, because every time we've tried to lower this line or flatten it out a little bit, it's caused some volatility in the equity market. So certainly something to pay attention to as we see going forward. The Fed is expected to possibly announce a taper coming up in November, but again, we will see if they have the stomach to cause market volatility by making this announcement. So with that, I know we had a few questions coming in. So let me try to pull these up briefly. I'm having trouble pulling my chat screen up. There we go. So the first one is, and in case you can feel free to take this one. You talked a little bit about the COLA increases earlier. Can you talk a little bit about what effect that would have in terms of the planning process?
So from a planning process, a big part of what we do is we look at cash flow and we evaluate that on a long-term basis versus your goals and versus the expectations of the market. And so through that process, we want to make sure that you've got a sustainable plan that will work long-term to continue to keep up with inflation and to maintain your lifestyle. We want to make sure that lasts for several years until the second death. So we can then, based upon, what if you need a larger increase for withdrawal purposes, we can look to readjust your plan and see how that impacts the long-term plan and what we need to do from a tax perspective, how to tax efficiently think about providing that stream of income to you next year, given some of the potential tax changes that we have coming as well. So there's a lot of components that go into it, but please don't hesitate to reach out to your advisor and we can talk specifically about what that looks like and what that means for your plan.
And then one more, are we concerned about the situation going on right now in China as it relates to Evergrande? So for those who aren't familiar, Evergrande is a very large property development company in China who has recently announced a default. And what I would say is, as the default plays itself out, I think there will be other victims in this, other property developers in China, obviously creditors in that country as well. And I think I mentioned this last time, I don't know that the People's Bank of China has the stomach to allow something like this to become systemic, considering what we've seen with Lehman Brothers. I think that was kind of the eye-opening default that has now set the standard. And I would expect them to throw massive amounts of money at this issue were it to become significant. So for now, I don't think it's a huge concern. Could it turn into something worse? Of course it could, but I think for the time being, I don't see it as a major systemic issue going forward. So Casey, I think that's all the questions. If you want to go ahead and wrap us up.
Sure. So thank you so much for attending our webinar today. If you have any questions, don't hesitate to reach out to your advisor and Doug. We can certainly pull Doug into a conversation, and he always makes himself available, and he's a great resource. So please, if you've got additional questions, don't hesitate to reach out, especially given we were experiencing higher inflation. If you're experiencing that and we need to make adjustments to your cash flow, then we need to talk and set up a meeting to plan and discuss that. Another thank you though. We've received a number of referrals this year from clients, family, friends, and that's the best compliment that we can get. So thank you so much for entrusting in the confidence and faith that you placed in our organization. That is something we do not take lightly and is greatly appreciated. Thank you.